Guys, I just learned this brand new finance trick, and I'm going to show you how it goes. So you take a $5 bill like this, right? And then you place it into an empty wallet like this. And then you close the wallet up like this. And then you reopen it and it becomes 100. That is weird, right? That's very strange, isn't it? But enough of the magic. Let's get into the video. What's going on, guys? So you clicked on this video, so the chances are is that you're thinking about refinancing your home, but you probably don't know all the ins and outs of the refinance process. Well, the good news for you is that by the end of this video, you'll have a complete understanding of how to refinance your home and do it the smart way, right after you obviously smash that like button for the YouTube algorithm. I mean, let's face it, the traditional school system didn't teach us all that much about this whole refinance thing. But the good news for you is that by the end of this video, you'll have a complete understanding and be able to pick the best option for when it comes to refinancing home based off of your specific lifestyle. I plan to break it all down. I mean, from interest payments to principal payments to when's the actual right time to finance your home. I'm even going to give you a step-by-step walkthrough from start to finish. And last but not least, the options that you have when it comes to paying those closing costs. Sound good? Cool. Let's start off with a chart that most banks don't want you to see. The Amortized Chart is a breakdown of loan payments, usually from month to month. It distinguishes between the loan payments on what is actually going towards your interest rate and what is actually going to the principal item, aka your house in this situation. Putting it simple, it shows the length of the loan and what payments are going to the interest and what payments are going to the actual house itself. In this chart, I decided to show a typical mortgage of 30 years with 20% down. The blue line represents the interest payments, and the red line represents the principal payments. The left side of the table shows the percentage, and the bottom of the table shows the years. If you can see from the table that in the beginning years of your mortgage, most of your payments are going directly towards interest. On average, it takes about 222 months to be able to start contributing towards the actual principal cost of your house. Now that you have a basic understanding of where your payments are actually going over the course of your mortgage, let's jump into when's the actual right time to refinance your home. Introducing the 1% rule. Refinancing your home to save 1% is often worth it, and the reason this is because a 1% rate drop usually generates a meaningful monthly savings. For example, dropping your rate from 1% from 3.75% to 2.75% could save you $250 a month on a $250,000 mortgage, which ends up being a monthly savings of 20%. That 20% monthly savings can be put into other things, like daily expenses, investments, or pay off the mortgage faster and save even more on interest.
Wow, that's actually impressive. So how do I get this whole refinance process started sooner?
Slow down, dude. First, we have to select which one of the options we want to choose when it comes to refinancing our home. We're going to get really mathy here, and I'm going to show you a physical example so it's easier for you to follow along. Let's say in 2010 you bought a home for $300,000 with 20% down, and the loan that you ended up taking out was the remainder amount, which is $240,000 with a 4.5% interest rate. This ends up translating to $1,246 a month in your mortgage payment alone. Now, let's act like you made all those payments on time over the course of 10 years. So now we're in 2020, where your house has changed in value, and I'll show you again and through this table. So the year is 2020, and your house is appreciated at 4 to 3% a year. So now your home is valued at $400K, and you've paid the loan on time for a total of $184,000, and you want to refinance your home down to a 3% interest rate. You have three options in this situation. Option 1, reduce your interest rate, which will reduce your monthly mortgage from $1,246 to $776. Option 2, you can shorten the length of the mortgage by continuing to pay the same amount on a lower interest rate. In this case, we'll drop the length of a mortgage from a 30-year mortgage to a 16-year mortgage. Option 3, cash out and take the money and reinvest it into other investments. This is done by getting an 80% loan on the value of the home, which is now $400K. Which in this case will have you pay more monthly at $1,349 a month. Got it? Feel free to rewind the video if you need to hear the options a few more times, but we're going to jump into the next portion, the actual refinance process from start to finish. Whatever you choose, whether it be lowering your interest rate to make smaller monthly payments, or shortening the length of your loan, or even cashing out, once you decide what option works best for you, then it's time to get with a mortgage advisor or a loan originator. The documents you will need are things like income and asset documentation, and they may also require other things like mortgage statements, tax statements, depending on your specific situation. If everything works out, then they will move forward with your electronic signing and disclosure of your application. Once they collect your signature, you then move on to the processing stage. If it's required, a loan processor can order an appraisal, a title search, or a lien search to make sure that there are no outstanding liens and they know about all the mortgages tied to your property. After this, they send your loan into a preliminary underlining approval. This is when an underwriter looks over your documents. The underlining approval is done twice back to back. The second time is called the clear to close. In the clear to close, your file will go over to the closing department. The closing department is responsible for coming up with the closing disclosure, or what is called the CD in the real estate world. The CD will have all your final numbers, all the way down to a penny. By federal law, the closing department is responsible for sending the CD directly to you 3 days prior before the closing date. Once the documents are signed, there's a 3-day wait period on occupied homes before they actually disperse the loan. The reason this is because it gives you time to go over the loan and you can still back out if needed. But if it's an investment property, the loan will be dispersed the day of the signing. The last step is to fund your loan. This is when they send a wire transfer to your mortgage company to pay off the loan in full. Usually, the refinance process takes anywhere from 15 to 20 days on average. But now that we have that down, let's get into the options that you have when it comes to paying those closing costs. First, let's talk about the types of closing costs you will pay when it comes to refinancing your home. The origination costs. These are things like underwriting, processing, and if you choose to use your points to lower your interest rate. Title settlements and recording charges. These costs go towards the insurance company and the attorneys for them to do their title search and title insurance. You'll also need to pay the town or city to record the mortgage. And lastly, escrow deposits. These go towards things like property taxes, homeowner insurance, and flood insurance depending on where you're located. Now that we have the closing costs out the way, it's time to talk about the options that you have. The first option, pay out of pocket. In short, write a check. Most first-time refinancers think that this is the only option that they have, which is not the case. The good news for you is that there's other options, like rolling those closing costs into your mortgage. This means that you won't have to pay out of pocket and can instead just make monthly payments on your closing costs just by paying your mortgage. Your last option is a lender-paid closing costs. In this option, the lender offers to pay your closing costs, and in exchange, you are willing to take a slightly higher interest rate. Final notes. As you can see, there's a lot of options when it comes to refinancing your home, but it's up to you to pick which option is best based off of your lifestyle and your specific financial goals. If you have any questions, feel free to comment below and I'll do my best to get back to you and try to guide you in the right direction. Disclaimer, I'm not a financial advisor, I'm just trying to provide people with the information that our school system failed so heavily to do so on. So the real question is, what option is best for you?